market's idle on what is the beginning of a month-end process here for financial markets. First week back after last week's would-be improvement. And we face now the decision time. Obviously, last week was a little bit more palatable for the markets than was most of this month. This week, we are going to test whether that little break and that little ray of maybe sunshine is lasting or fleeting. And that is because an absolute avalanche of macro risk faces investors this week. I'm Ilya Spivak, head of global macro here at tastylive. This is Macro Money, and we're going to go through all of it. There is quite a bit, but it does seem to follow a bit of a story here, because what we are, as ever, looking at is the idea that the world is able to digest all kinds of things as long as there's growth. You can write off all manner of volatility provided there's money to be made tomorrow, as it were, whether you're a business or a consumer or an investor. But if there's no growth, and that's a hit to demand, it's a hit to employment, well, then bad news hits different, as it were. And so the question we're going to ask increasingly this week is, are we already in a place where growth has hit the wall? We'll start the conversation with a look at what the markets did last week and posit why perhaps they did it. And from there, see what it is that is so critical this week that might get everyone back up in arms. Here's the performance across the key asset classes last week. We can see stocks manage a rebound here, and a pretty decent one at that. S&P 500 up 4.5%, NASDAQ up 6.3%. That's pretty impressive vigor there. The story in the bond market reflecting perhaps the easing concern around what looked in April like a sort of sell America dynamic, where U.S. stocks, U.S. bonds, and the U.S. dollar were all falling in tandem. There seems to be a bit of an unclenching here. The 10-year down 1.8%, the 2-year down 1.2%. That's not because the Fed got any more dovish. That's because of the term premium surge that was the hallmark of April seemed to have eased a little bit going into last week. There seemed to be a sort of peak in a level of uncertainty around this idea that we are heading into some sort of a sovereign crisis in the U.S. That, of course, was a very palpable sort of concern. It's how we ended up with bonds crashing and yields surging, even as stocks went down and the dollar weakened. That would normally be the kind of environment where you might think, oh, well, the Fed's going to come cut rates. There'll be firefighting. But no, that was not how that worked out. And ostensibly the reason is because the markets were so convinced that uncertainty downwind is elevated that they built up the highest compensation for duration risk into 10-year treasuries since the middle of 2021. That, of course, drove yields sharply higher. So last week's give back seems to speak more to this idea that maybe we're unclenching a little bit around that kind of risk. That helps to explain how you get yields coming in, bonds coming up. You don't get that kind of a response in crude oil. It continues to march to the beat of its own drum. But gold a little bit lower. The dollar stops falling, if not outright rallying against the euro, but it does manage to score a little bit of a gain against the yen, which comes in about 0.9%. The risk-on vibes certainly carry over into Bitcoin. It has a very sharp rally of 13%. So as you look at all of this, you get the sense that perhaps that kind of hair on fire sovereign risk in the economy shepherding the world's reserve currency, that kind of concern has ebbed. And it seems like it has ebbed perhaps because the administration, on two separate occasions, once the 10-year yield got to levels they were uncomfortable with, around 4.5%, seemed to walk away from the brink. First with the sort of softening of the rollout of reciprocal tariffs, saying there's a 90-day stay of execution on tariffs above 10%. That, of course, is something that the markets greeted as a welcome kind of thing, not necessarily because it's so good economically. It's not. And that's because when you have an average tariff of 2% and you go to 10, you've increased taxes on imported goods fivefold, as it were. And so that's obviously going to hit consumers, and surging inflation expectations amongst those consumers speak to their realization of what's about to occur and what's coming downwind. But that the administration seemed responsive to an emerging crisis in the bond market and acted accordingly suggested that there is, in fact, a reaction function to market discipline, and that was encouraging. There was a similar instance then again with the on-again, off-again firing of Chair Powell. The president seemed to signal that that's not an avenue that he's going to pursue, even after just days earlier posting on his Truth Social platform that Powell's termination date, quote, can't come soon enough. So there again seemed to be a walk back once fears about compromising the central bank's independence again took yields toward that telltale 4.5% level on the 10-year note. So it seems like we're in a place last week where the markets go, okay, well, it's not a great environment for risk taking, but it's not the implosion of the most important bit of architecture for the global financial system, that is the dollar and the Treasury bond as a risk-free benchmark asset. That is not what this is. And with that, you get stock markets unclenching, you get yields coming in, the dollar steadies, gold comes down, and the markets now look ahead to what was the narrative before April's fireworks, from about mid-February and into March, the idea that we're careening toward a global recession, but maybe just a regular one, and not some sort of an existential crisis, though, of course, recessions aren't easily predictable. Once a drop-off in growth starts, you never quite know which skeletons it'll dredge up out of the closet. All of a sudden, debt to GDP ratios start to surge because with weaker growth, servicing all manner of debt is more difficult. And so the upshot becomes, well, now you need to do something that could be raising cash. Now you need to do something that could be laying off workers. And so all of that has significant implications, maybe downwind, that the markets are not prepared to price in yet, but at the very least, maybe this will be just a recession and not the imminent collapse of the empire, as it were. With that, we have pockets of data in the week ahead from all three major nodes of global growth to see if we can't get a sense for whether, in fact, we have some kind of a situation here where recession is either inescapable or perhaps has even kicked off already. We start on the Asia-Pacific side of things. The Australian CPI report is due. It's looking to show us that inflation continued to come down in the first quarter, 2.3% on the headline, 2.9% on the core, which is interesting because actually Australia's economy has been relatively peppy. Looking at the PMI numbers over recent months, but most of it has been domestic demand. And the really key indicator here, and sort of how this data fits into the overall story, is what it means for growth in China, because, of course, China is Australia's largest export market, and that part of the Australian growth story has been terribly anemic. It is also an absolutely critical part of how Australia continues to grow and would purport to continue to grow going forward. So if we get weakening inflation, it'd be interesting to see how the markets onboard that and whether they perceive here that what this means is that the drag, the downwind effects of a weak China are finally starting to spill over into the dependent economies, and even strong domestic demand isn't helping things work out. And that's what we are going to be watching for closely here. If these numbers miss and if their internals suggest that weakness is already coming for Australia despite some recent support for the domestic economy, well, then we're starting to see China's weakness spread out. That's an important part of this global recession story. For China itself, numbers don't look all that great as we prepare for the release of official PMI numbers. We'll get the private sector versions, the Caixin and S&P Global numbers later as well. But the official figures kick us off here. And the expectation is that China's economy stalled in the most recent data. That April saw the economy basically get back into contraction mode. The composite index here seen slipping to 49.5 as manufacturing hits a wall, 49.9. As ever in the logic of PMIs, 50 is neutral. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. 49.5 here on the composite index would indeed be a sharp deceleration and a move back to contraction territory for the first time for China since going all the way back to December of 2022. Now, we can see here that services are expected to remain in growth mode, but at a slower rate, 50.7 down from 50.8 in the prior month, and manufacturing is seen going back into contraction mode for the first time since January. So the story here looking weak, and the GDP numbers we've already seen out of China for the first quarter, they sort of reinforce this idea that we are now looking at 8 consecutive quarters, shocking though that is, of economy-wide deflation in China. The story here that nominal GDP is running below real GDP, which means that the inflation adjustment that one needs to make to get from nominal to real, that is negative. And for the first quarter, it's negative to the tune of 0.8 percentage points of GDP growth, which multiplied over the second largest economy in the world is a huge gap. Basically means the economy lacks for demand, and that, in fact, the gap here is the most steep since we saw the peak one at negative 1.06% in the first quarter of 2024. So this is looking like very much reinforcement of that, and the idea that that economy is stuck and going nowhere. The Eurozone seen posting growth of just 0.2% in the meanwhile in the first quarter. That's a repeat of the prior month, and again, pointing to standstill. That economy, as we can see here, has been basically idling with low to no growth since the latter half of 2022. Likewise, coming out of the Eurozone, inflation data, 2.1% expected on headline CPI. That would be the lowest that we've seen headline inflation there since October of last year, where we briefly dipped below 2% in September and then hit 2% on the dot in October. This would be the weakest since then. Again, speaking to deceleration, speaking to weakening price pressure. Of course, growth and inflation tend to work hand in hand. You get more growth, you get more money changing hands, you get more demand. That demand starts putting more pressure on whatever supply there is. Supply can't keep up with demand, inflation goes up. Sort of classic story of economic acceleration. Deceleration works the other way, as we can clearly see in China's case, which again has been in a de facto economy-wide deflation now for 2 years. We have there a situation where there isn't demand, and so the entire economy is basically in the bargain bin, where you try to lower prices to clear inventories so you can start to build new things and grow again. And so in seeing this kind of weakening of inflation, not just in the Eurozone, but of course, as we just talked about a second ago, in Australia, you get the sense that there is economic deceleration that's afoot. And then, of course, there is the US. Here, things get very spicy. The expectation is that you're going to get a 0.4% rise in GDP, which, relative to where we've seen these numbers, is abysmally low. The last time we saw anything like this was the second quarter of 2022. In fact, outside of that, from the third quarter of 2022 to the fourth quarter of last year, average GDP has grown 2.9% annualized every quarter on average. And of course, there's some standouts. There's some weaker ones. There's a 1.6% growth rate in there in the first quarter of last year. There is a 4.4% surge in the third quarter of 2023. But the average for the U.S. economy from the middle of 2022 onward, sort of second half of 2022 through the end of last year, is to be growing at an annualized rate of about 3%. So to go to basically no growth at all, obviously very eye-catching and is very close to getting us to confirming what would be the first step to a recession, which is 2 consecutive quarters of negative growth. There's not much margin of error for a miss here. Speaking of weakening inflation and the implications for growth there, PCE inflation data coming out. This is the Fed's favored inflation gauge. Here, you're coming into 2.2% on the headline, 2.6% on the core. And again, these are, as we can sort of just glean by looking at the chart with the naked eye, these are meaningful levels historically. 2.6% on the core would be the lowest since September of 2024, or June, of 2024. So we're talking about the weakest in almost 10 months. Then when we look at the headline, 2.2%, that's the lowest since September of last year. That was actually the reference point I was looking at a second ago there. And of course, all of this, again, speaking to perhaps diminishing demand and the impact of that on price pressures. And of course, the Federal Reserve has been screaming that what they want to see is hard data to hang their hat on so that they can begin to cut rates. But where that hard data has actually shown up already, in the inflation data, where we've seen that core services inflation has been cooling for a few months now. As we can see, most inflation lives in that core services area. That's where the U.S. economy has found growth, where other economies have not, since the middle of last year until it abruptly hit a wall at the start of this year, looking at the PMIs. around tariff uncertainty and sort of the broader uncertainty around the rollout of U.S. fiscal policy, be it on immigration or on trade or on any number of issues. And that what this means then is that you have a solid foundation now telling you between the GDP and this, and of course the data is still incoming, which we'll get to momentarily, that recession is nigh. The updated set of PMI surveys, for that matter, from ISM, the Institute of Supply Management, will report the manufacturing sector numbers this week, services next week. Both are expected to slip below 50, so both are seen in contraction mode. Accelerating contraction is what's on the menu for manufacturing, ostensibly because front-running the tariffs is no longer an uplift for that sector. Nothing else to front-run. The tariffs are here. And the service sector, we'll see that next week. That's expected to get back into contraction mode, and of course, that's between 70 to 80% of the U.S. economy, the service sector. So clearly not great footing there. And finally, the cherry on the Sunday here, bearish Sunday, but nevertheless, is the non-farm payrolls report, expected to give us 135,000 jobs added in the most recent data here in the sort of repeat of what was expected last time. Of course, 135 is where we saw it in March, and then the economy outperformed a little bit, gave us 228,000 jobs. We're coming back to still that 135 number here for April, and it wouldn't be so far out of the norm. As we can see here, it's kind of within the range of recent values, but nevertheless, a weak result in relative terms. And of course, the jobless rate seen holding at 4.2%. And again, while that is not terribly high historically, it also matches the high on the range that has held really since we saw unemployment back at 4.2% the last time, which was back in 2021. So here is the range of values, and we're expected to be at the top of it. The last reference point for where unemployment is like this is back here. So in all, not a happy story. And as we just said, this is a rundown of all three major engines of global growth. Between China, the Eurozone, and the US, you have 58% of global GDP. If these numbers come out anything like what is expected, even if they are marginally a little bit better, despite the fact that global economic data has tended to disappoint over recent weeks relative to forecasts, according to data from Citigroup, even if it's a little bit better, we nevertheless are looking at such glaring slowdown that a global recession seems almost inescapable at this point. And that, of course, has been the main issue. As we've been looking at the PMIs here, we can see that since the middle of last year, China and Europe have been increasingly weakening. The US was a pillar of strength until the start of this year, when we get this rapid shift lower in US economic growth around this tariff uncertainty. And so the US is essentially converging on weakness in the other two major growth nodes. And without the US to be the offset here, there really is no safety net. That doesn't bode well for cyclical assets like crude oil or stocks, but perhaps it can finally put a bid into the bond market, because if the markets think this is going to be a regular recession and not the empire self-immolating, as they were apparently concerned about last week, then it should mean lower rates, and it should give the Fed the ammo it needs to start talking about rate cuts in earnest in May, and then perhaps even starting those rate cuts with gusto in June. And that is Macro Monday for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go from there. I'm likewise on with Chris for Futures Power Hour Mondays and Fridays. On with Victor Jones for the Price of Truth on Wednesday this week. Back with Victor and Tom for First Call Sundays. Writing for the News and Insights portion of tastylive.com. Commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.